Hey folks, David Frost, my strategic forecaster here for another episode of Common Sense Market Analysis. Today is Thursday, August 30, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And so we had a down day today, and we discussed this a couple of times over the last few days, which is we're eventually going to have a down day, and we're going to work off some of this overbought condition. Right now, as a reminder, we're still in an uptrend, so technically speaking, there's nothing wrong with this market. However, obviously, we're a little bit extended from home base. We talk about this all the time. The market never really likes to get too far away from home base. Thus, either the market will eat some time off the clock by going sideways for a while, and what that'll do is it'll allow home base time to rise. As you can see, we're in a rising trend, so home base will be rising. All the moving averages are rising. So if the market goes sideways for a few days, home base can rise up toward price, and then price can then move higher as a result of coming back toward or having home base come up toward price. Now, the alternative to that is we come down to home base, or we come down near home base. Could the SPY come down all the way to where home base is now, around $286? It could. Am I expecting that anytime soon? No, not necessarily. There is another alternative, is we obviously continue to grind higher. That is a possibility. I'm going to give you what I think is going to unfold over the next several days and beyond in a moment. First, let me take a pause and thank everybody for continuing to participate and make comments and posts underneath the video each and every night. They're helpful to the entire community. I love the interaction. Please keep up the great work. In addition, hit the like button on the video and share the video with those people you think can benefit from this information. So here's what I think is going on, and I'm going to try and keep this as simple as possible. We've been looking at signals over the last few days that were a potential canary in the coal mines. We talked about the IWM. We'll talk about that again in a few moments. We talked about the VIX a number of days in a row, and it was pretty apparent that the VIX, if it didn't break lower, could be setting up to pop higher, and that's what it did. And the VIX was also signaling that something was amiss. There was a disconnect or a divergence between the S&P 500, what the VIX was doing, and what a couple of other markets were doing or weren't doing in terms of making new highs. So we did have a few canaries in the coal mine. So let me kind of summarize what I think is the likely scenario over the next few days. And we have to keep a couple of things in mind. Number one is we're leading into a 3-day holiday weekend. So the volume across the markets, tomorrow being Friday, and when we get back on Tuesday, likely to be relatively light. Doesn't mean we can't go down. I'm just bringing it up because we know, generally speaking, the path of least resistance in light volume tends to be higher. Okay, so if we get a pickup in volume, as we did today, we didn't get necessarily more volume than yesterday, but we had a pickup like we did yesterday over the last several days. If we have another pickup in volume, could we have a down day? Yes, we could. Am I expecting downward activity into and around the holiday weekend? Not normally. However, today was a little bit of a surprise. Now, the other day, I was indicating to you that I thought Wednesday could be a down day. So apparently today is Wednesday. Today, Thursday, turned out to be what I was expecting on Wednesday. We had a down day today, and I do expect a few more down days. I do expect, at minimum, they don't have to be big down days, mind you. I'm not looking for a collapse in the market. What I'm looking for is the market to work off some of this short-term overbought condition, let the market reset a little bit, and I still think that there can be higher prices. I do think there's going to be another push higher, even in this move. Now, can there be higher prices later? Yes, there can. However, right now, I think the market is running out of gas in and around where we are. It's not to say we can't go $1 or $2 higher on the Spider from where we are, but right here, right now, I'm favoring a pullback. It doesn't have to be a big pullback. It can just be sideways for, let's just say for argument's sake, 3 or 4 days, maybe 5 days, something like that. And at that point, you'll see where the 20-period moving average will be. It will be nearer to price at that time. We have a couple of important areas. We have what's called a gap window right here. That low is right around 288.68. So say 288.75, 288.50, somewhere in that neighborhood, we're likely to find a decent amount of chart support based on that gap that exists on this daily chart of the SPY. There's also a gap fill area, and for me, that's at 287.50, slightly farther down below, but still above the 20-period moving average. So we know that there are two pretty major, in my mind, areas of support. And what do markets like to do? They like to come back and test former breakout and former breakdown areas. For me, those are two important areas of likely support if the market does come down a little bit. And I do expect that at least at some point, logically speaking, the market's going to come down a little bit. Yes, we're in a melt up, the vacuum, the whole 9 yards, but nothing goes in a straight line and it can't go up every day indefinitely. You have to have pullbacks along the way. For example, the market goes up from here to here. First, it goes up from here to here, consolidates, similar to a pullback, same concept. It was eating time off the clock. Then the market goes up a little farther, pulls back. Market goes up a little farther, pulls back. How long did these pullbacks last for? Roughly a week or so, maybe a couple of extra days. Those of you that have taken the course at lazyemintrader.com understand the meaning of some of those important time frames. And we know time is more important than price, and markets make important turns at important prices at important times. And I'll just deviate for a minute and just point something out just to prove the point I just made. So markets make important turns at important prices at important times. So from this pivot high up here, the market goes down for an important amount of time and makes a pivot and goes higher. Was that at an important price? Yeah, because the market consolidated first. So we consolidated, market went up, we came back to test the former breakout area. That's exactly what happened. And the market took about the right amount of time to do it. Market goes up, it pulls back again. From there, we had determined at the time that this price level was important. This was, and we said it at the time in one of these videos, that was a big time day. That was an important reversal day. That being said, what did the market do? It went up for a few days, it topped out, and then it went down for an important amount of time. Didn't quite get all the way down to that 279.16 area, but it came down toward it, so it was coming down toward an important price. It made a turn at around an important time, and so you can start to see how we put these things together, and these are the type of things that are taught in the course at lazyemintrader.com. So let's summarize the daily chart of the spider. The bottom line is if we close above yesterday's high, then I'm wrong in thinking that we're poised right now to at least go sideways to lower for a few days. A close above yesterday's high will negate that. That will be off the table. Until and unless that happens, that's my vote. That's my short-term bias, is for some downside activity to emerge. The support levels hold what I said before. It's around this gap area here and the secondary gap down below. Those are logical areas of support. I'll refine those areas for my intraday traders, obviously. Here's the hourly chart of the spider. I just want to point something interesting out, and I think we set it up here. The market was making another bullish pattern, and I said, here's another bullish pattern, and likely story is, under normal conditions, that means another push higher. However, one of these bullish patterns at the highs will fail, and that's obviously, it's not a revelation. I'm not trying to be Captain Obvious or anything. Eventually, something fails at a high. It's just the point was you can see the market stair-stepping its way higher, continuing to make these bullish patterns one after the other, dating back quite a ways. And that was my point, was eventually, as it stair steps higher, you're going to run out of steps and you're going to fall over the edge. And that's pretty much what happened thus far. Now, all we did today from an hourly chart perspective is come back to test the former hourly breakout. So that's obvious garden variety intraday trading activity stuff, right? So here's where the breakout occurred. So the market consolidates in here, breaks to the upside. We come back. Where do we find logical support? At the former breakout area. That happens over and over again on any chart you want to look at. If you want to go down to a shorter time frame and take a look at what that appeared to look like on a 10-minute intraday chart, it looked a little bit different than the hourly. Looked like the market was rolling over, and it may be temporarily at least a little bit rolling over. So the market was rolling over, and we're coming down, and we come down into that area. We come short of it. We bounce up a little bit. We come a little deeper into it. At the time, this 200-period moving average wasn't really near price. So price really didn't get close to the 200 down here. On the first run, that would have been a trade. This wasn't a trade for me because the 200 was as close as it was. But nevertheless, it's late in the day, leading into a long-term 3-day holiday weekend. I'm not really looking to put a lot of risk on late in the day, certainly unless something slaps me in the face. Let's move on to the IWM. So here's another interesting chart. So the other day we have what I like to call a pseudo doji candle. You could make a case there's a topping tail in the IWM. And I said any trader can be short on a daily close above that high. So that's the trade. You take the trade and you abide by those type of rules, meaning if, for example, yesterday or today, we got above it today, if we closed above that high that occurred on the 27th, then you have to close out the trade and you book it as a small and quick loss. And if we have to have losses, and we do from time to time have to take losses, it's just part of the game. It's part of the business. We have to accept that fact. And when we do, we like them to be small and fast. In this case, that's what it would have been. It would have been small and fast. However, that's not the case. The trade still happens to be active from that day on the 27th, or even the little retrace on the 28th. And we'll see what happens. Now, I can say that the market's consolidating to go higher. I can say that it's just going to consolidate sideways and eat some time off the clock. Let the 20-period moving average or home base come up to price, just like we discussed in the spider. I can certainly make that case. However, I still think it's a little suspect. There's somewhat of a canary in the coal mine in the back of my mind flying around that says that that candle from the 27th and the fact that we put in a very similar type candle today, that just canary in the coal mine type thinking tells me that until and unless we close above the high from the 27th, then that's still on the table and we can still have some downside. We're still in an uptrend. It doesn't have to be a lot of downside. What if we came down to the 20-period moving average? What if we came down to this breakup candle low? That's 169.12. Happens to be right now around the same number as the 20-period moving average. That's around $3 lower in the IWM. That would put the S&P 500 down, 20 or 30 points, something like that. And that's a down day or two. It's a bad day, or it's a bad day back to back twice in a row. That's about it. It's not a big deal one way or the other, and it allows the market to basically work off some of the overbought condition. So in terms of the daily chart, that's my thinking in the IWM. You know where the trade for the short side would be wrong, and my thinking is we come down a little bit, but I'm not looking for a big sell-off. I still think there's more upside coming in this market. Now, we're still in an uptrend, and that thinking can change, and it will change once certain levels, price levels on the downside are broken, and that's not the case today, and it won't be the case for quite a little while. So I just want to make everybody aware that I don't want you to think I'm a perma bull, for example. I know I've been calling for higher prices. There will come an end. There will be a reversal at hand with a meaningful correction from this move, but I just don't think that's where we are right now. Taking a look over at the VIX chart, you can see this is the pattern that we've been discussing in the VIX. Quite apparent and obvious what happened today. We had a big move higher in the VIX. We went up into the 100-period moving average, $13.86. Yesterday's closing price happened to be $12.25. So it's quite a good move, hefty move in the VIX. And what we were talking about was the fact that until and unless the VIX closed below that low and it challenged it one time, this was a bullish pattern, likely a bullish pullback pattern. An up move, you have the pullback. This is a garden variety retracement, right? From the low anyway. And then all of a sudden you have another takeoff to the upside. Now, there could be a case that this goes all the way and completes an ABC pattern, the C leg being the final leg completing above the high of the A leg right here. However, we're not there yet. We don't know that that's going to be the case. It is possible, but the VIX is and happens to be playing out without a close below the low that occurred on the 10th of August. Without that close below that low, it is playing out to the upside as we discussed. Looking over at the transports. Yesterday we talked about the fact that, again, my second favorite market leading indicator, the IWM being first, we just talked about that at length. The transports being second, and the transports, we talked about another potential canary in the coal mine. Why wasn't the transports breaking out to new highs when the S&P 500 was breaking out to new highs the other day? Why were we struggling making a double top that we made from the other day and pulling away from it? So I was thinking that was another potential canary in the coal mine. And today you can see we were down about 0.75% in the transports, maybe more downside in the cards. Whether we go below the 20-period moving average or not, we'll see. I tend to think we will, although it's close by, and right now there should be some support at the 20, although we've already had support at that area. You see what happens? So let me explain what I just noticed as I'm discussing this. Sometimes it takes me a second or two to notice something because I'm trying to think and talk at the same time. Imagine trying to think, talk, and type at the same time. It's a near impossibility. So here's what I'm looking at. So just from a sheer chart pattern perspective, what I would say is we have a move higher. And you can take the move higher from down here if you want, or you can take it from here. Doesn't really matter. It's the same thing. We're up here and we begin to consolidate. This would be somewhat of a flag pattern that would likely result in a move higher or a continuation move. Okay, fair enough. That's what I see from basically the last couple of weeks of activity. Now, we just talked about the 20-period moving average, and you know how I always say, at least twice per video, markets like to come back and retest former breakout and breakdown areas. Well, if there's a former pivot high here, and right here, the market was telling us that that price level was important because we rallied up to it, and then price was rejected at that point. And yes, we rallied back to it and broke through, but at least the first time was rejected, and a very similar price level was also rejected down here. So we know there's a lot of chart resistance or overhead supply in this zone. Okay, fine. We got through that, and we've come back to retest one time already. Let me clean this up and show you what I'm talking about. So just from a short-term perspective, we broke away from or out of that pivot top over here. Okay, so the market thought that price was important. We broke out above it. We came back to retest it already once. Then we tried to go back higher, and price was rejected at the highs. Now we're coming back down. Are we just going to, and this is where I'm going with this, are we going to just banter back and forth like this and then finally break out to the upside, or are we going to fail and come lower than that former breakout area right here once again, because we already tested it once. So even if we came into the 20-period moving average here, would I take that trade to the long side here, right now, like tomorrow, for example, if it came into that? And forget about the fact that this is the transports. Forget about the fact that you would have to trade the IYT. I get all that. Doesn't matter. This could be any chart. Doesn't matter if it's a stock, a commodity, a 10-minute chart, a daily chart. As you know, and you know what I'm going to say now, all charts act and react the same way. So the question is, would I take that trade on the second go-around of a test of that breakout area? And the answer is, no, I would not. The first test is always your best opportunity. The second test, not so much. Not saying it won't work. We might bounce around back and forth up in this zone, create another bull flag pattern, pardon me, and then go higher. And that would be okay. And that would mean, if that happened, that retest of that breakout area did work. But I'm not willing to take the trade on the second hit. I'm willing to take the trade, generally speaking, on the first hit. How about looking at the Qs? So we're obviously at highs on the Qs. Again, very similar conversation to the spiders. Overbought. We put in a doji candle today. Is it meaningful? Is it going to signal at least a short-term top? It might. It might just be a signal of a trend change for a short period of time, go sideways to slightly lower, let the 20-period moving average or home base work up to price, one way or the other. It's really the same conversation we just had in the spider. I'm not going to rehash the whole thing. It's the same routine. Long term, we're in an uptrend. I don't think this is the end-all, be-all to this rally, but I do think we're poised for a pullback, and I think we may be at least underway at this stage right here, right now. As far as the Qs are concerned, a close above today's high, and that scenario is completely wrong and will continue to grind higher. Since we do this from time to time, we might as well look at some of the FANG stocks, the leading stocks, the fan favorites, the widest held stocks in the hedge funds and mutual funds and all that. So here's somewhat of a pseudo doji candle is an Amazon. Is that telling us something? Amazon got to a high today. Let me move this over. Amazon got to a high today of $2,025.57. Pretty remarkable. I'm not sure whether it reached, like Apple did, its $1 trillion goal or target area. I'm not sure what that price is, but we may have reached it today, and that may be, a pretty good reason for some kind of a pause or pullback or just even a breather. But obviously in a very, very strong and powerful uptrend. But could this be the sign or signal of at least a temporarily changing trend, even if it goes sideways to slightly lower? Yeah, it could be. Look at Apple. Apple had a big update today, and then it pulled back into the end of the day. So that's interesting. When you look at the 10-minute chart of Apple, you'll see here that we actually fell away quite a bit from the highs in Apple. There's that bullish pattern again, failing near the highs. Eventually, one of them has to fail at a high, right? So came into the 10-minute 50-period moving average and then found some support there. But that was a pretty nasty decline for Apple from its highs. Its high price was $228.26, and the low was $223.82, and that was this afternoon's low, not before the opening price. Facebook is in a little bit of a world of its own. It's struggling similar to Apple today in terms of the end of the day. It was a little bit of a sell-off, but Facebook is somewhat broken, and what this chart is telling us right now is likely story is lower prices are coming at some point in Facebook, and not just by $1 or $2. When you look at the weekly chart, what this is telling you is this is kind of like a shot across the bow. This is a reversal. This is a meaningful reversal. That's a absolute taken out behind the woodshed type of reversal, and that's generally not the signal of a new bull market rally starting. It's generally the sign of one that just ended. But certainly, Facebook can work its way with higher prices, even back up near $200. You all know how I feel about these type of candles. That's a whopper of a breakdown candle. Switching over to Netflix. Again, Netflix not at highs like the Qs were. So, that's also interesting. So here's a high and a lower high. Or here's, I can even do it differently. I can do it more dramatically like this and say here's a high up here and a lower high and a potential third lower high. Now, I don't know if that will be or won't be the case, but it's just interesting that one of the market leading stocks is not of the same appearance on the charts as the Qs, and it is partially, at least in terms of the Qs, overweighted. Here's Google chart, a daily chart. Again, not at highs in Google either. So Amazon and Apple have really been the two stocks that were really leading the Qs to what I'll call the promised land, I guess. Who knows? Whatever you call what the Qs were doing of recent. But when you look at some of the other stocks, they're not making new highs. So there are some divergences out here. And I know there are some traders out there and some analysts out there that like to use MACD as an indicator. I don't use MACD, but when I see stuff like this, I'm sure that when we start looking into some of the MACD out there and we look at some daily charts and even some longer term charts, you'll start to see some divergences appear at some point sometime soon if they're not starting to appear already. Now again, just realize what I'm saying. What I'm saying is the market can still go higher, doesn't have to go 10 or 20% higher, but it can still go higher. But understand that the likely story is a lot higher before a meaningful correction is unlikely. It's possible. It's not necessarily probable. Remember, I don't know when it was, maybe a week or so ago, I began discussing, and I will continue to discuss, the fact that I do think over the next several weeks, we need to begin watching for some kind of topping signals for a more meaningful correction in the S&P and across the major markets. Now, whether that was today or it happens a few weeks from now, I'm not exactly sure. It could be today. I'm just not thinking, and nor am I convinced that it's today. So right now, what I'm thinking is, and I'll just draw it out just for argument's sake. If I were to use a blank canvas and say, what would the market look like over the next, let's say 3 or 4 months? I think it would look something like this. Assuming, or not assuming, but here's where we are today. So assuming that we have somewhat of a pullback over the next few days, and that's somewhat of an assumption, but let's just say that happens. So we go sideways to lower, not a big one, not a big deal. So we do something like this. And then we have another rally and we make some higher highs like this, okay? Not significantly higher highs, but higher highs. So where are we in time when that occurs? So let's say here we are today at the end of August, okay? So maybe this is another week from now, for argument's sake, right? So let's say this is into the end of next week. We get back from Labor Day, Tuesday. So this is something end of next week. And then maybe we go up for 2 or 3 weeks or something like that. We punch through, make some higher highs. Everybody gets extremely bullish. And that's at the point in which I think we put in some kind of a reversal candle. And that's at the point in which we have, and let me just redraw this real quick. And that's at the point in which we'll have, so we're here, we go make a slightly higher high, and then we have something that looks like this, and this may last for maybe 2 months, couple of months, 2.5 months, and then here's some kind of a bounce that ensues into the end of the year, into the January timeframe. So I'm thinking maybe you have a low around the end of October, Thanksgiving, in that time frame. That tends to happen more often than not. It's a seasonal type of perspective on the markets. So that's kind of what I'm thinking. We'll see how it works out. The market definitely is not going to do whatever it's going to do on my terms. It's going to do it on its own terms. The financials today. So they struggled a little bit, down 0.7% on the broker-dealer index. You can see where we found support. Pretty obvious area. We had a 50-period moving average on the daily chart, and we also had, in the very near vicinity of that, a breakup candle low that was a likely area of support. That's what happened today in the broker-dealer index. It was a down day. We got back below the 200-period moving average. That's not necessarily good news for the bullish case of the XBD. When we look over at the XLF, again, we're just going back and forth, but there's no technical damage done. It was down less than 1%. It's 22 cents, 7/10, 8/10 of 1%. You can see, again, same story. Where did we find support today? When you look at the daily chart, you can see a breakup candle low. The breakup candle from the 27th, the low was 28.34. What was today's low in the XLF? 28.31, and then we popped up a little bit, closing above the low of that breakup candle. But again, we're above all the moving averages. Can we come down a little bit if the market sells for a few days? Yeah, we'll probably have to. Again, they're all going to move together. Rising tide lifts all boats. And also, when the tide goes out, everything goes down a little bit for the most part. SMH. I forgot this one last night. My apologies. And with the SMH, we had one of those interesting scenarios. So we had a close above the former high. Now, we've read this book before. We've been to several of these movies. In fact, we've seen the entire series. So here's what I'm talking about. So we had an important high. How do we know this is an important high? Because the market rallies up to this point, is rejected, comes back to this point, is rejected again, but finally closes above that high. That high was 109.36. So the close yesterday was 109.64. Now today we have a down day and we're down 1%, trading away from that high. So here's what I'll say. If there are higher prices across the markets like I think there are, then there should be higher prices in the SMH remaining. However, if we start breaking below these moving averages, that's going to be good night for the SMH. So it's important that we maintain above these moving averages. Now, the last line of defense is going to be about 104. If we get down below the 200-period moving average, we may get some kind of a rally from there. We may get some kind of a support level down there. However, I wouldn't necessarily be expecting it. That's a long way off from where we are. I'm not trying to scare anybody. Again, if the market has one more push higher, which I believe it does, the SMH could have one more push higher too. However, let's keep this in mind, and this is important. The SMH is also a leading indicator. It's traditionally a leading indicator across the tech sector. That being the case, if the markets are going to start to diverge and you're going to start to see money rotate away from risk a little bit at a time when we're at highs, assuming we didn't see the highs already. Maybe we did, but let's just say we didn't. The SMH can certainly play a role in that, and you may not see the SMH come above yesterday's high if that's the case. Something to be aware of. Above these moving averages, still okay. Just be aware of the entire picture. Gold. Well, interestingly enough in gold right now, we start to see something emerge. So right now, what we're seeing emerge is a bullish pattern. So all along, on the way down, I kept saying the trend is down, there's lower prices coming, but I kept finding it difficult to find a place to short, or at least a place I was comfortable, maybe once or twice, but a place I was comfortable taking a swing trade or positional trade short in gold on the way down. Okay, that's item number one. We talked about the highs when the highs were there, but that was a long time ago. Now, I've been saying there's nothing to do in gold. There's nothing to do. Let the market bottom. Let it find a low. We discussed the low from a couple of weeks ago. We had a low in here, and we said as long as that low holds, we got a little bit of a retrace. We start to trade away from it, a little bit of a pullback. Then we close above a breakdown candle high. That's positive. We have this breakup candle from the other day. That's the one that closed above the breakdown candle high. So this candle from the 24th is now our new line in the sand. So that low happens to be 1189 spot 50. Now, it's a little bit ways away from where we are now in gold terms, in the world of gold, right? So if we're buying a gold contract, each dollar movement in the price of gold futures is $100 per contract as you're holding them, obviously in either direction. So here's what I'll say. As long as we hold above the 20-period moving average, gold remains bullish and will likely build some energy, continue to build some energy for another push higher. Where would that push higher likely, at least on a temporary basis, find some overhead resistance? Natural area would be right around 1230 or slightly above it, depending on when we would get there, where the 50-period moving average comes in right now. So that's your story in gold. My preference would be, if I were to see gold trade down intraday, for example, lower down toward the low of that breakup candle low, that may interest me at this point in time. Right now, not yet, but I'm looking at it, I'm watching it, I'm becoming interested, I'm becoming intrigued in gold. Crude oil. Crude oil's doing everything that we said it was going to do. We closed above the breakdown candle high. We consolidated for a couple of days. We're above the moving averages. We continue to move higher. We have a big area to contend with, right around $72 or maybe even slightly above. There's a high of the breakdown candle is 72.76. Could we get up all the way there? Sure. I'm using 72 as the big fat round number that we may have an opportunity to get back to in short order. Can we start talking about getting back up into the hot zone just yet? Not just yet. We would have to first close above 72.76. A close above that would be important, and then we would begin talking about back into the hot zone. And this video is definitely long in the tooth, and I apologize sincerely. I'm definitely out of wind. It's everything I wanted to and intended to discuss and a whole lot more, so I'm definitely going to give it a wrap. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.